Bert Herzog is on the line. Bert, great to have you back here, sir. Founder and director at Executive Wealth Management. Let's jump right into this market, which is just powering through bad data, powering through crude oil futures collapse. Bert, does it make sense to you? Are you piling in and riding the wave back?
Well, you know, Oliver, I've always been optimistic about the markets. My glass tends to be more half full than half empty. But right now, we've been rather conservative. We do feel that future earnings, particularly in the second quarter, aren't really going to support the current market environment. So we've been very, very selective on what we're doing. We're prepared to be defensive, but at the same time, look for opportunities because we will eventually get out of this. It's just right now, we're not looking very bullish until we get a better grasp of what's going to happen with second quarter earnings. Probably the same story that you're hearing from a lot of analysts.
So does that mean cash, Bert? Are you in cash right now? Did you take profits in companies? Did you axe the losers? How do you go about managing decisions right now?
Well, we've been getting defensive ever since the middle of February. We are certainly looking for opportunities as the market pulls back, but we have been defensive since the middle of February through March. This reprieve in the last 3 weeks, I think, is kind of an opportunity for people to reevaluate where they're at, make sure that they're positioned for what we think is probably another drawdown, but there will be opportunities there. And I think it's important that when you have that opportunity that you take advantage of it.
Yeah. So right now, I know that in the stocks that you do own, Amazon has come back to a high, and they've demonstrated that maybe they really do run the world no matter what's happening. Bert, is Amazon a pandemic trade that fades, or is this just proving that any valuation and any price is possible for Bezos' giant?
Well, it certainly is a giant, and I don't think that moving forward that it will in any way, shape, or form not be around as a powerhouse stock. What we believe is that Amazon is something that should be strategically required as pullbacks occur. And what I mean by that, coming back 10 to 15%, that's inevitably going to happen. I do think that Amazon is a long-term hold for someone that is looking to buy a stock that they can hold for the next 10 years.
So for Amazon, how do you figure out what it's supposed to be as part of your portfolio? Is it the entire discretionary exposure? Is it tech for your cloud exposure through AWS? I mean, it's a huge part of the market, obviously, and there's a lot of folks that say this concentration of market cap in the top 5 needs to break.
That's a great point. It certainly isn't something that you want 100% exposure for your cloud-based securities or for your supply chain. But it is a position that you should own in a diversified portfolio. We do own Amazon in both of our emerging growth portfolio and our growth portfolio. Obviously not a dividend payer, but Amazon is a position that you cannot afford not to hold over the next decade.
Yeah. What else? You mentioned defensive. How do you define that in this market? Is it utility stocks that are tied to rates? Is it actual staples, basic goods makers, Procter & Gamble's and Kimberly-Clark's of the world?
Staples are definitely an area where we have exposure. We, again, have pulled back on the consumer staple area, but we still own quite a bit of Procter & Gamble. We have a position in Walmart. We are looking at staples as being a core piece to our portfolios so that we can weather the storm through what we consider is going to be another pullback.
Through a broader market move where the staples perform again, how does it get better for these companies, though, Bert? That's what I'm kind of wondering is, like a Procter & Gamble or a Kimberly-Clark, how do they ever see the toilet paper demand and the tissue demand that they did, during this shortage and this just panic that hit throughout the last month of the previous quarter? I mean, will they ever see that type of move again where these companies are doing 5-10% revenue growth?
You got a great point there. Again, you need to be strategically positioned to acquire these positions on a pullback, a 5 to 10% pullback, which we anticipate in the next several months as second quarter earnings come out. We're kind of right now, Oliver, we're in what I call the eye of the hurricane. We've had a pretty good 3 weeks here. The markets have stabilized. The VIX has come down, but I don't think we've hit the back end of the hurricane yet. When earnings come in second quarter, you just don't turn the economy off like a light switch. We need to turn it on, but it's going to be turned on more like a dimmer switch. And we got to be prepared to take advantage of opportunities, which I think Procter & Gamble and Amazon and Microsoft and other cloud opportunities will be there, but you need to do it strategically on 10 to 15% pullbacks. You also have to consider the balance sheet of these companies. Are they going to have the cash and the debt situation to survive this market? There are going to be a lot of companies that are going to struggle at the end of the summer. But
Bert,
again, my glass is full. We'll get out of here.
Yeah, I like that. Bert, last one, Apple. This is on your list as well. Is this a company, I mean, as you just mentioned, there's tons of cash, don't have debt problems. The stock has been a rock for a long time. Goldman Sachs downgraded to a sell this week, though, and it kind of put a damper on its strength.
Again, we like Apple. We think that Apple at 250 to 260 is a great buy, perhaps not at 282. And we do think that there will be some pullback on Apple as we get through the earnings seasons this summer. So big long-term bull on Apple. Kind of look at it like Amazon, where there is an opportunity to add to this position, take advantage of it. Apple is not going away.
Okay. All right. Bert Herzog looking for dips to buy, a half full glass, and still maybe ready to put some of that optimism to work when this market drops a little bit. It's been running, and it's got a strong session here. Bert, join us from Executive Wealth Management. Pleasure as always talking stocks with you, Bert. Have a great weekend.